Tonight, we will be looking into the Unemployment Insurance Weekly Claims Report published by the Office of Unemployment Insurance. We will start on the OUI homepage at oui.doleta.gov. A lot of information presented here will be looked at in depth in a future episode on the Unemployment Insurance Program. The Office of Unemployment Insurance, or OUI, is a sub-agency of the Department of Labor's Employment and Training Administration, or ETA. Unemployment claims are filed by workers through state-level agencies, and the data is reported to OUI. The data is then compiled, edited, and published as the Unemployment Insurance Weekly Claims Report. This report is often used as a near real-time indicator for layoffs and company closures, as noted by surges or persistent upward trends. The weekly report can be accessed from here. Here's a look at the weekly report from June 2nd, 2026. This shows two main data points: initial claims and insured unemployment. Initial claims are new unemployment insurance claims made in the prior week, representing the flow of newly unemployed workers into the unemployment insurance system. This data is from the week prior to the report. Insured unemployment, or continued claims, represents the stock of existing unemployed workers who have continued to collect UI. This data lags the initial claims data by 1 week. If initial claims is increasing or sustaining elevated levels, this indicates an increase in overall unemployment due to layoffs, company closures, and other factors. If insured unemployment is increasing or sustaining elevated levels, this indicates that workers are not able to find work and are remaining unemployed for longer periods of time. The ideal is for both numbers to decrease, showing a robust job market where less people are losing their jobs and more people are finding new jobs faster. What we have in the current initial claims data is 215,000 claims for the week ending on June 27th. The 4-week moving average is 222,000. In the graphic, we can see a very flat trend line for the past 12 months. For a shorter timeline, we can look at the FRED data for 2026 year to date. Here we see the range has chopped between 190,000 and 230,000 initial claims, with an average of around 213,000 per week year to date. This is very close to the latest week's numbers and lower than the 4-week moving average. This is not indicative of large layoffs or mass firings, but is also not a sign of growth. This is evidence of the hiring freeze that was inferred in the Indeed job postings episode, as well as prior episodes on other federal data sources. Back to the report. The latest insured unemployment or continued coverage number is 1,814,000 for the week of June 20th. The 4-week moving average is 1,803,000. The insurance unemployment rate is at 1.2%. The insurance unemployment rate differs from the BLS unemployment rate because it only represents people actively collecting unemployment checks. State restrictions on duration of benefits cause this rate to drop even if workers don't find jobs. This is why there is a gap between the insurance unemployment rate of 1.2% and the unemployment rate of 4.2%. Continuing through the report, we can see the unadjusted data, which includes dips and spikes that recur annually. Here we see an increase from the prior week, which is common for late June and is thus averaged out of the seasonally adjusted data. This note indicates that no states are actively using extended benefits, which is an unemployment insurance extension program used during recessions. Additional details include federal employee claims and states ranked highest for insured unemployment rates and claim increases. We also have comparisons of current data to prior weeks and years in these tables. Initial and continued claims are broken down by state, with this table specifically showing the state that the claim was filed in. This table shows weekly changes over the past year. And here we have data similar to the prior state level table, but with a revision to account for the applicant's state of residence instead of the states where the claims were filed. Here are the states with increases or decreases greater than 1,000. States are also able to submit comments or rationale, but most do not. And finally, we have technical notes and definitions, all of which have been explained within the context of this episode. In conclusion, the current unemployment insurance data is not signaling a major uptick in either new or continued claims, but is also not showing declines. With continued claims steady, this could indicate that a steady stream of hiring is pulling down the number, but the new claims are refilling it. On the other hand, this may also indicate that the new filings are simply replacing those who drop out after receiving the maximum benefits allowed by their states. We will look deeper into the unemployment insurance program in the future, but for now, we will continue to review sources of job market data in an effort to complete a bigger and more nuanced picture. Good night.